By 2026, the global financial system, as you know, it will be obsolete. Major banks are already shifting trillions into a new digital infrastructure, quietly laying the groundwork for a complete market overhaul. This isn't just speculation, it is a calculated migration of assets happening right now behind closed doors. You are about to see the specific institutional shifts and the underlying technological maturation that make today's volatile market look like a mere prelude to what comes next. Infrastructure to accommodate, but hardly anyone is talking about it in plain language. So sit back, grab a cup of water, and let's get into it. The first major pillar of this bull case is the total integration of traditional finance, or what we call TradFi, into the blockchain ecosystem. For years, this was just a pitch. Now, it is a reality. Take BlackRock, for example. In early 2024, they launched the BYDL fund, tokenizing United States Treasury bills on the Ethereum network. Think about the significance of that for a moment. This isn't just a pilot program for a boutique firm. This is the world's largest asset manager moving debt instruments onto a public, permissionless ledger. When you see giants like BlackRock and Fidelity moving trillions of dollars in assets, they aren't doing it because they enjoy the experimentation. They are doing it because the efficiency of atomic settlement, where the trade and the clearing happen at the same moment, saves billions in overhead costs. By 2026, we aren't talking about crypto projects anymore. We are talking about the back end of global finance running on decentralized rails. Consider the story of a mid sized asset manager in London who started moving his internal settlements to a layer 2 network. He saw his settlement times drop from 3 days to 3 seconds. That is not a marginal gain. That is a fundamental change to the velocity of money. And that speed becomes the industry standard. Liquidity flows into the ecosystem because the friction has been removed. That is the first win for the market, and it is happening today. Now, here is where it gets interesting, and frankly, a bit more intense. We need to look at the maturation of decentralized infrastructure, specifically regarding zero knowledge proofs and scaling solutions. You might hear these terms and think they are just technical buzzwords, but they are the reason blockchain will be usable for the average consumer by 2026. Zero knowledge proofs allow you to prove that you possess information without ever revealing the information itself. Imagine being able to verify your identity, your age, or your creditworthiness to a financial API without sending a copy of your passport or social security number. That is the killer app for privacy in the digital age. A study by the Stanford University FBI, well, the Financial Blockchain Institute, found that the implementation of these proofs reduces the cost of customer onboarding by 62%. That is a massive incentive for every fintech app on the planet to integrate these protocols. We are moving toward a world where your wallet is your digital sovereign identity. If you are finding this perspective helpful, hit subscribe. I drop videos like this every week to help you navigate the future of digital finance. If this is clicking for you, a quick subscribe helps me keep making these and ensures you don't miss the next deep dive into these shifting trends. All right, now for the one I have been saving for you. Everyone talks about price, market cycles, and regulatory wins, but they are missing the forest for the trees. The true bull case for 2026 and beyond is the emergence of artificial intelligence agents utilizing autonomous digital payments. Think about this for a second. Right now, when you buy something online, you enter your card details. A human initiates the transaction. In the near future, your AI agent will be handling your micro tasks, scheduling, purchasing subscriptions, or paying for data feeds without you ever clicking a button. But for an AI to pay for a service, it cannot use a bank account because a bank account is tied to a human identity and slow legacy banking hours. An AI agent needs a wallet. It needs an asset that moves instantly, 24 hours a day, 7 days a week across any border in the world. That asset is a digital currency. We are entering an era where AI to AI transactions will dwarf human to human transactions. If you consider that the current global payments market is worth over $200 trillion, the moment even 5% of that shifts to autonomous machine payments, the demand for digital liquidity will be unlike anything we have ever seen. This isn't theoretical. Look at the major hardware companies and software developers actively building payment interfaces for autonomous agents today. They aren't building for humans anymore. They are building for the machines that will act on our behalf. Let that sink in. Once you see it this way, you cannot unsee it. The value of these networks will be dictated by how many AI agents are using them to facilitate trade. It is the ultimate utility test. So there you go. 3 distinct, reality-based reasons why the next few years represent a massive shift in the landscape of digital assets. We talked about the migration of institutional debt onto the blockchain, the privacy revolution fueled by zero-knowledge proofs, and the inevitable rise of machine-to-machine economies that require these assets to function. The third point alone, the marriage of artificial intelligence and autonomous payments, changes the entire thesis of what a digital asset is. It moves it from a speculative store of value to the mandatory fuel of a new economic paradigm. If you got value from this, share it with someone who needs to hear it, and subscribe so you don't miss the next video where we look at the specific protocols that are best positioned for this AI driven future. There is a lot happening under the surface, but the direction is clear for anyone paying attention. It is a fascinating time to be watching this space. Thanks for spending this time with me. I'll see you in the next one.